I'm going to solve the question, so if you haven't submitted yet. The announcement I made was about investment competition of a big bank in Turkey. So you can form a group of 3, and then you're going to make investments. They're going to give you some virtual money, and then you're going to make investments on it. And if your team is one of the first 3, then you're going to get some reward. So if you're interested, let me know. I'm going to take your name, and then let the dean of econ department know about it. So don't forget about it. It's an interesting opportunity. Okay. I'm going to solve the homework question first. I'm not going to put the answer online. I'm already solving it here. So this says there's a product based on new technology, has 2 major potential markets, A and B. The dominant uncertainty associated with it has to do with the technology rather than the markets. So either the technology is a success or a failure. Accordingly, the product will succeed in both or fail in both with equal probability. The markets are otherwise independent and may be entered sequentially or simultaneously, either now, 1 year from now, or 2 years from now. So there are 2 markets, A and B. With A, you're going to make an initial investment of 100. And then this is regardless of when it is entered. If the product is successful, market A will have a present value of 160 1 year after the entry. And if the product fails, then it will be worth 80. Market B requires an initial investment of 55. And it's going to produce either 140 or 25. And then it says, for simplicity, perform all discounting in this problem at 5%. So discount rate is 5%. So in the first part, it says, what is the NPV for each market, assuming each is entered immediately? So what am I going to do? A is the simplest one. I'm going to say, what is the NPV of entering the market A? What is the NPV of entering market B? So how am I going to do this? These probabilities are always equal, success or failure. So what am I going to do? I'm going to calculate the expected profit, and I'm going to deduct the cost of entering the market. So in this case, I have for NPV A, I have 160 or 80 with equal probability in year 1. So I need to discount it and bring it to time 0. So this is the present value of your expected profit from A. And then you're going to deduct 100, the cost of entering the market. So for A, NPV will be equal to 14.3. Okay, so I'm going to do the same thing for B. If you enter B now, then you're going to have either 140 or 25 with equal probability. And since those returns are at time 1, I need to discount those and then deduct the initial investment. So NPV will be equal to 23.57. This part was easy, right? Right? Right. Okay. So, okay, these are the NPV. So which looks like a better market? B looks like a better market to enter first because it is producing more NPV to you. Let's look at part B. It says, examine the possible combinations of time and place for introducing the new product. Can any possibilities be eliminated as suboptimal without further calculations? Why or why not? Which entry strategy is optimal? Okay, I'm going to calculate the NPV for different cases. So the first one to do is, the easiest one is NPV if you enter the market, enter both markets now. So if this is what you do, what is the NPV? You enter both of the markets now. Exactly. You add those two things up. So MPV will be equal to something like this. 38. There's a rounding and stuff, so okay. Okay, so this is MPV of entering both markets. The second one is what? You can enter both markets in 2 years, for instance. Let's calculate this one. Enter both markets 2 years from now. Okay, so if you enter both markets 2 years from now, how am I going to calculate the MPV? So the value of entering both of the markets now is 37.9. So this is basically whenever you decide to enter those two markets together, this is the MPV you're going to get. But if you enter the markets 2 years from now, this is going to be the value of it at time 2. So I'm going to discount it two periods back. So 37.9 is entering both markets together. But now this happens at time 2, so I'm going to discount it 2 years back.
So what am I doing in time in the first year?
Oh, we're going to do the same thing.
Okay. In the B, we enter both market at the second year, right?
Yes.
So what am I doing at the time?
Oh, nothing. Nothing. So the question says, okay, so it says you can enter sequentially, simultaneously, either now, 1 year from now, 2 years from now. So you can just wait 2 more years and enter in 2 years. Or wait 1 more year, enter in 1 year. It's just one option. Doesn't make sense, just I'm trying to cover everything. So if you do that, then the MPV will be 3434. Okay, so if you enter both markets in 1 year, then the MPV will be between those two numbers. So you will just you're going to do 37.9 over 1.05. So you can do that, but it's going to lay in between those two numbers. Did you understand what I did here? It's just kind of a shortcut. So this is the value you're going to get whenever you enter both markets together. This is what happens in time 0. Since in the second option, I'm thinking to enter both markets in 2 years, I'm discounting the value in 2 years. Okay, so the confusing part, the more confusing part is actually sequentially entering the markets. So first, I'm going to enter A, and then I'm going to enter B. Okay, so A now, B later. If it is the case, what am I doing? My decision tree will look like this. If I enter A now, I have to pay 100. Then I'm going to make 160 or 80. Success or failure. If it is failure, are you going to enter B? No, it's failure. So you will only enter when you have a success in market A. So when you enter B, you have to pay $55, and then you will either get 140 or 25. Yes?
Why can't you enter market B if A is failure?
Because it says you will only enter when you have a success. You already failed. It will be suboptimal. Yes?
So is it possible to be success in A and fail in B?
No, because it says the technology will either be...
Okay. So in that case, we will be successful in both A and B.
Okay, wait.
Because if I'm successful at A, that means I will be successful in B.
Oh, that's a good point, actually. I didn't think about it. That's good. Yeah, I didn't even actually think about it. So let me see. If you okay, it is about the technology. If the technology succeeds, it's going to succeed in A. So it should also succeed in market B. But what if it fails? Okay, this is how I actually focus on the question.
Like,
but you're actually right. It's going to be...
If the market A fails, you can have a chance in the market B. So,
Sorry?
like if the market A fails, you can
Yes,
have a chance
then,
in the market B. So.
Yeah. I think what the question is trying to say, which is not very clear, is if it's a failure, it's going to fail in the second market as well. But if it's successful, then you're gonna implement the other one, which might turn into a failure. But it's not clear from the question. So whatever you understand, if you translate into the paper in your work, then I'm fine with it. But you're right. It's just the way I understand is a little bit different than yours. I'm not saying I'm right. It's just different, but they're both right.
So will you calculate it?
Yeah, we can. Yeah, I'm going to calculate it that way. If not, yours is even easier because you're getting rid of this one as well. Okay. And you can tell me what the answer is
So
actually.
in that case, if I would fail in B, that means I had to be failing.
Exactly. No, I understand what you're saying. Yeah. Makes sense. What you say makes sense. No, what you say makes sense actually. Yeah.
Question doesn't make sense.
I'm gonna let this guy know about it. You can actually write reviews on those kinds. So I will let him know. I will let him know. Okay. So this is how I actually solved it. I said, okay, it's I'm entering A first and then B later, which might produce those two outcomes. So what I did was I actually calculated the value of this part. So I did, it's going to give me 140 or 25, and I'm going to discount them one period back, and I'm going to deduct the initial cost for entering B, which will give me 78.33. Then I said, okay, so if I invest in A now and then B later, here I'm going to get 78.33 on top of 160. So I did, okay, I will either get this from the upper branch or I will get 80 from the bottom branch. Then I'm going to divide them by 2 because I can be in those branches with equal probability. Then I need to discount it one period back, and then I'm going to deduct 100 as the cost of entering A, which will produce 51.6. Yes?
How did you take the probability of market B?
I did. It's either 140 or 25.
50%?
Yes, they're both. Oh, sorry, I forgot. Yes, so there should be. Thank you. Okay. Thank you. Okay. So the way you calculated, what was your number? Huh? No, the way you calculated, do you remember your MPV? Huh? The same number? Okay. Maybe the way you solve is correct. So I'm going to look at your homework. Okay. Okay, so this is what happens if you enter A now and B later. The other one is, you can see, this is better than entering A alone or A and B together at time 0. So you increase the MPV actually. Yes?
Here, the result is not 76. 78, sorry.
Okay, you're okay. Tamam. Okay, this. Thank you. You're right. Okay, I was just. 78 var. Okay, let's try it one more time. I'm so sorry about confusing you because for some reason I cannot read what I wrote here. He was absolutely right. So if you enter A now and with success, you will definitely get 140 as it was success. No, you're right, and your answer is right, and I thought something else. Okay, so if it is the case, then you will definitely get, let's get rid of this 25 because it's going to be success. So in that case, 140 will be discounted back one period, and then you're going to deduct 55, which will give you 78.33. Could you check this? Somebody just check that number. It should be correct. Huh?
Ödevde biz böyle çözmedik.
Arkadaşlar bunu bir dener misiniz? Şunu bir dener misiniz? Yani sadece doğru mu diyor bakın. Okay, tamam. İlk başta şeyi yanlış ettirdim. Okay. Okay, so this is correct. Don't worry. I was just confused about what I wrote here first, whatever. Okay, so as let's go one step back. Let's try it again. You entered A now. It was success. You decided to enter B. Since it was a success in A, it's going to be success in B as well. So in time 1, you're getting 160 from the market A. In the second period, you're getting 140 from the market B. So this is time 2. I have to bring it to time 1 by discounting in one period. I need to deduct the cost, 55. Maybe you don't remember the number because you changed the order of calculations. I mean, it's fine. The result is there. So if it's a success, you're getting 78.33 here. On top of 160, you're going to get from market A. So you add those two numbers up. This is what happens if you're successful in market A. And this is what happens if you fail in market A. If you fail in market A, you're not going to enter B because it's going to be failure. So it's going to be suboptimal. So again, these are equal probability. Add them up, divide them by 2. This happens in time 1. So discount it one period back, then get rid of the 100. Okay? So it makes sense to enter A first and then B later. Okay. But maybe it makes more sense to enter B now and A later. So I'm going to do the same thing. This time I'm entering, what was the cost of entering? Here. I'm entering B first. I'm getting 150 or 25. If I get 140, if in a success story, then I'm going to enter market A. So I'm going to get 160. So it's going to be success and success. Again, to enter A, I have to pay 100. So I shouldn't forget about it. So what happens is I'm getting 160 at time 2. So I'm discounting it one period back. And then deducting the cost from to find the NPV of market A. So this is what's going to happen if you become successful in B. So on top of it, you're going to make 140 if you have a success. If you have a failure, you're going to have 25. So these are going to be with equal probability. So you can add them up and divide them by 2. This is going to happen at time 1. So you're discounting it one period back. And of course, don't forget to deduct the initial cost. So you're going to have 48.5. So,
I think we should add another branch to pay the property.
why?
Because it says like if the market fails first, the other one fails too. So
Yes.
there's another possibility of the both market fails and the both markets have.
Yeah, but it's going to be suboptimal. So you're not going to do it. Like I'm not looking at this because it's not going to be failure for sure.
Okay, then
Sorry, if you have a success, it has to be success.
okay. I think we should add another branch to do like 25.
Okay, and 25 and the other one will be 80.
Yes.
Okay. We may, we can do that. And but the point is, whatever you do, your general strategy should not change. Whatever you do, this is going to have higher NPV compared to this one, for sure, because you're going to do the same thing here. So you can check. So basically, if you cover all the possibilities, then what's going to happen? You can either enter both of the markets now, which will give you 37 NPV. You can wait 1 year or 2 years, which will give you even less NPV. You can enter A first, B later, or B first, A later. But the strategy producing the best outcome will be entering A now and B later. The question is, can you think about any general strategies related to that?
Low volatility.
Okay, well, low volatility what? Exactly. So it's all about getting rid of the uncertainty. If you look at volatilities, so if you look at how far you are from the expected returns, obviously which one is more volatile, A or B? Let's go back to this one. So the average of these is what? 120. So you are either $40 more or $40 less than 120 here, volatility. Here, the average is what, 80 something, 86 or something. So you are really far away from the expected returns. So what it means is when you have a decision like this, you have to go with the certain market first. But it is, of course, this question specific. You're going to enter that one first. Why? Because you want to see whether you have a success or failure, and then you're going to decide about the other market. So if you can be more sure about what you're going to see in the first step, it's going to be better for you. So B has high volatility, and it makes more sense. And if you think about options framework, which is more valuable, A or B? B is more valuable. So since it is more valuable, you have to wait to exercise that option. You have to wait to exercise entering market B. So go with the certain case, and then if necessary to exercise the option, wait until the expiration date, whatever that date is. Use the high volatility one as an option backup. In part D, actually, it is trying to make you support your general rule. So it says now, suppose that there is C, market C. It will be worth either 55 or 40. So basically, in this one, it has the least volatility, actually. And MPV of entering C will be something like 5. So it will be very, very little. But it will make most sense to enter C first. I mean, I didn't solve the possible things with C. But basically, it was just to support your first or general decision. Yes?
How can we generalize the strategy only on volatility since the means are different from, like, expected returns are different?
It's not only that. So when you first do that, you see that MPV of A is very low compared to B, right? So to you, it looks like MPV is higher for B, so go with B first, right? But actually, when you have the option to wait and see which market will, whether your technology will be successful or not, you should go with the certainty case. Because the second market success depends on the first one. So the sooner you see whether you're success or failure, the better it is for you. And with the volatility question, you're going to leave the uncertain market later, and it's going to be a more valuable option for you to wait because of the volatility to enter market B. Anything else? Okay. Sorry for that confusion there. For some reason, I couldn't translate what I wrote here into the on the board. But you got the idea, right? I mean, it was part A and B was not that difficult, I think. Part C was more about thinking which strategy might be better. It was an open-end question, so if you couldn't understand exactly what it was asked, it's fine. It was just like a little intuition essay type question. Okay. Wow, it took 30 minutes. Perfect. Any questions? No? Then I'm going to start talking about mergers a little bit. Okay. You know about mergers at all? Okay. These are really, really important corporate events. Experts on mergers, lawyers, and finance consultants make tons of money, especially in the valuation part. One of your case, actually, I think two of your cases is kind of about valuation of mergers. And I started writing suggested case questions already. I'm almost done with it. So tomorrow I'm going to send the questions for all of the cases. Please start solving cases like immediately because they're taking a lot of time. Believe me, they're driving me crazy. They take lots of time. Just start early. Okay, so mergers are what? Mergers are the easiest way for companies to grow. So when I say grow, actually two kinds of growths can happen. One is internal growth. So companies try to find good projects and make investments, and hopefully those projects will turn into more money and more growth. But easier thing to do for companies is to acquire another company. So when they want to grow, this is an external growth, they go buy another company. So mergers are also markets for corporate control. So when you take over another company, you control that company, of course. You take the control as well. And merger market is really ridiculously high. So it's 1 trillion per year is spent, let's say, as a transaction value every year in US. So these are pretty important corporate events. When there's a merger, you see two parties. One is, of course, the acquirer or the bidder who is interested in buying the other company, and the target company is the seller of the firm. So there's buyers and sellers. So these are a couple of cases, mergers in 1998 to 2008 period. The most expensive one was valued at $203 billion when Vodafone bought MAN425. Then I have Royal Dutch buying Shell for $185 billion. So we're talking about ridiculous amount of money. When you look at 2003 numbers, even the biggest transaction was not as much as this one. So these are pretty important deals we see in the market. And another thing we see in the market is mergers happen in waves. So we have heavy merger activities followed by low merger activity cases. So in what kind of market do you expect more mergers to happen?
Growing.
No, I'm thinking about more like economy-wise. Like good market, bad market. In which case?
It depends.
Okay.
For example, in US case, many banks merged during the economic crisis.
Yes.
It was a bad situation. But in Turkey, for example, many banks merged with foreign banks.
Yes.
It was good economic situation.
But when do you spend money? Do you spend money in bad times or good times?
Good time.
Good times. So high merger activity is generally seen in good times when companies have cash to spend to buy other companies. I mean, in this case, Vodafone paid $203 billion, so which means it should be in a good time. In a bad time, nobody would spend that much money to buy another company unless you're very sure you're making excellent investment and it is absolutely necessary for you. But I'm going to show you kind of interesting facts about mergers in a second. Okay, so when you look at merger waves in US from 1960s to 2009, you can see there are a couple of periods where we see lots of activities, merger activities. Like here you can see those, and these were generally conglomerate waves. So in that case, people thought that good managers can manage any kind of business. So they were just buying other companies in unrelated businesses. So they formed lots of conglomerates. Then we see another activity here, early 1980s, maybe just after the crisis time, always. And in this part, we see hostile takeovers. And I'm going to tell you what hostile takeover is. I will give you the definition, but as you can understand, it's hostile. The target company doesn't want to be acquired, but the acquired company does a couple of tricks to buy that company. And we're going to talk about those. And in those years, basically, it was just after the not just, but 20 years after the conglomerate waves. Basically, what happened is acquired companies look at which divisions were not working. They bought those poor performing conglomerates, separated the company, and then sold individual divisions at a higher price. So it is just the opposite of conglomerate waves in one sense. Then in the late 1990s, we saw more strategic or global deals. So this was more about synergies, creating economies of scale, and taking a better role in the global markets. Then in the 21st century, we see lots of mergers in the telecom and software part, like Cisco. Do I pronounce it correctly? Cisco, the company. Okay, that company, it was a very small company, but it started lots of other companies, and now it's one of the biggest in its industry, for instance. So we see those kind of mergers in 21st century. Okay, so this is the historical way of looking at things. Let me give you some definitions. Today I'm going to spend lots of time just blah-blahing, so hopefully you're not going to sleep in this late afternoon. So we can have merger or consolidation, we can have acquisition of stocks, or we can have acquisition of assets. Let's see what they are. In the merger case, one firm is acquired by another firm, and actually one firm dies. The target firm completely dies, and acquiring firm retains the name. And it is legally very simple, but of course, for a merger, shareholders of the target company must approve the merger. So approval is important. And there's consolidation. In the consolidation, A and B merge, and then firm C is created. So an entirely new company is created. Another way is acquisition. So basically, a firm can be acquired by another firm by buying the purchasing, by purchasing the votes of the target company. Okay, so how can a merger happen? I'm the CEO of a company. Alican is the CEO of another company. I call him and I say, I'm interested in your company. Could you buy your company? Could you sell your company for blah blah blah amount of money? Okay, and he considers that. Or I can directly go to the shareholders of Alican's company, and then I ask them whether you want to sell your stock, because mergers are all about taking the control. How do you take the control? You take the control by buying the votes of shareholders. And how can I do that? I can have a tender offer, which is a public offer to buy shares of a target firm. It's an open announcement. I say, if you buy Alican's firm, I want to buy that stock from you for $60. And you consider whether you want to sell your stock to me or not. Okay? In the stock acquisition, there's no stockholder vote. You're already deciding whether you want to sell your stock to me or not. So not in the merger case, I need target shareholders' votes to confirm the merger. If I buy your stocks, I don't need it. And even if the manager, Alican, is not interested, I can do the stock acquisition if shareholders of Alican's firm is interested. The problem with here is, I'm going to talk about this and I'm going to show you examples. Some shareholders are very, very smart. So it's like a game theory. If I come to you and say, I'm interested in your stock, sell it to me for $60, you know I need your stock. So if you're smart, you're going to say, nope, I'm not accepting it. So you're going to wait until I increase the price I offered to you. And in that case, actually, waiting makes sense for the target stockholders. So they hold out for more money. They're smart. They want me to increase my deal. Another form is acquisition of assets. So I can buy Alican's firm's all the assets, all the factories, all the plants at a negotiated price, of course. In that case, the selling firm can have its shell. So in the merger, the target firm dies. But in acquisition of assets, he can still have the name and everything. So he can start over. And the problem with it is target stockholder vote is required. So shareholders has to vote on it in the meeting. Okay, more terminology. We might have horizontal mergers, we might have vertical mergers or conglomerate mergers. We talk about conglomerate mergers. In that case, acquirer and the target firms are completely in unrelated industries. I don't know, like a computer company buying a food company. Okay. We might have horizontal mergers. In that case, target and acquirer are in the same industry. Like Exxon buying Mobil, they're both in oil industry. Okay, this is horizontal mergers. We might have vertical mergers. So in that case, one firm is in the supply chain of the other company, like airline company buying a travel agency, or oil company buying gas stations. Okay, so they are in the same industry in different places in the industry, though. Okay. We're going to talk more about this later, but we see all the details of the agreement in the term sheets. So when a merger happens, it is a very complicated process. I'm telling it as if it is very easy, but what happens, I call Alican, we talk about some price. We have to decide on whether I'm going to pay in cash, I'm going to pay in my company's stock, in the merged company's stock. Is it going to be a mix of things? So there are lots of considerations going on. All of those things will be on the term sheet. And stock swaps can be seen. In that case, it's basically a stock payment is in the form of stock. I make the payment to the target shareholders not in cash, but in stock, for instance. When do you think me, the acquired company CEO, is going to offer stock payment instead of cash payment to the target shareholders? Who is overvalued? Which stock? Me or my companies or Alican's? He's exactly right. If I know that my stock is overvalued, that was very good. If I know that my stock is overvalued, I know that the stock price will decrease, and it is the best time for me to get rid of my stock. So what am I going to do? I'm going to go to Alican and I say, okay, I'm going to pay everything in my stock. And this is a signal of me, my company's stock being overvalued. Okay, that was good. Did you understand what I said? Okay. Okay, so we talk about different cases of takeovers. In the acquisition case, we have acquisition of assets, acquisition of stock, merger or consolidation. We might have proxy contests. These are interesting because in this case, acquirer company wants seats in the board of the target company. Like, I'm interested in, I'm using your name a lot. Let's buy someone else's, John. Okay. Suppose that I'm interested in buying John's firm and he's not interested. What I can do is I can kind of take...
Some kind of bribe.
Bribe him? Oh, that would be easy. Okay. But I can ask John's firm's shareholders to give me proxy rights, voting rights. With those voting rights, I might try to put my people in the board of John's firm, and slowly and in small steps, I can take over his company later. But I'm going to talk about what he can do to defeat anything like this. There's actually staggered boards and there are rules about it we will talk about later. But this is what happens with proxy contests. The last one is going private. So we know that private companies can go public by issuing stocks. The opposite can happen. A public company can go private by a leveraged buyout. We're going to talk more about those probably next week. So this is another way of taking over. An investor buys a public company, and he might turn that company into a private company. Okay, it's just the opposite of going public. Okay, then what we have is, let's look at the reaction to takeovers. So when there is a takeover, there are two parties. One is the target firm, the other one is the acquirer firm. In a merger announcement, what do you think happens to target firm's stock price? Does it go up or down?
Most probably will increase.
Why?
Because the acquirer firm most probably will pay more than its market value.
Okay.
So, and market creation will get even that the price.
Okay, very, very good. How about the acquirer firm? Does it increase also? For sure.
Depends.
Why? It depends.
It actually depends on the kind of acquisition.
He's talking. Okay.
If they're in the same industry and it's like eliminating a competitor, it can increase, but it's like irrelevant industries, and the shareholders may not like it because they think that it will not contribute their competitive advantage in the market.
Okay, what else? You were saying something?
They are consolidated when their shares outstanding will increase, then market.
No, that was very good. Why did you?
Share price increase.
That was interesting. You're not. I'm very happy with your answers. All of your answers. Okay. Yes, these are the things we will talk about actually later. We're going to talk about reasons to acquire and what happens in real life. Let's look at the evidence first, and then we're going to go into the reasons of mergers. So basically, as Alican said, when you're interested in buying a company, you cannot offer them their stock price as of that day. You have to offer them something more so that they sell their stock to you. So whenever a bidder pays more than the current market price, it's called acquisition premium. Okay, on top of the stock price, I have to pay more to buy your stock. And if you look at the evidence, this is what we have. For the US deals from 1980 to 2005, they look at acquisition premiums. And they show that on average, companies pay 43% more than the market value of the target to acquire that company. And when we look at the announcement price reaction, target companies' stock increases by 15%. Stock price, acquire stock price increases by 1%. So you guys were right. Target firms enjoy when there's an announcement of a merger. It's a good thing. For the acquirers, actually, the results are very confusing. We still don't know whether mergers create value or not. We still have papers looking into that. But I have a couple of questions here. Let's go over those questions, and we will try to answer those questions later. So one is, probably the most obvious one, is why do acquirers pay a premium over the market value for a target company? Why do they pay a premium? To convince the shareholders or the manager of the target firm. Exactly. Although the price of the target company rises on average upon the announcement of the takeover, why does it rise less than the premium offered by the acquirer? If premium paid is 43% more than the current price, why the announcement target reaction is only 15%? About what?
About the future of the merged company.
Okay, about the process or the merged company? Okay.
The premium merger is more than the increase in the price because it's really hard to buy those stocks in the market. So assume that you buy the stocks in the market from the external shareholders.
Okay.
It's going to be very hard to increase the price a lot. So I think it's logical there is a difference between increase and premium.
Okay, so it might be very difficult to translate all the premium into the target price immediately. I think this is what you're saying. You're right. Alper is also right. He says there's lots of uncertainty about the merger, not just because of the whether the merged company is going to do well. There are lots of steps about the merger. Even if we agree, not you, John, no, not you anymore. I'm not interested in your company anymore. I don't know, you said no to me first, so sorry. So with John, even if we agree on everything, shareholders has to agree on it, then there are lots of regulations, laws, lots of things going on. Actually, lots of mergers actually fail. They don't finalize. So there are lots of uncertainty about it. And the last question is, why does the acquirer not consistently experience a price increase? That's very interesting. The acquired company pays all that money, and the acquired company is trying to convince its shareholders that it's a very good deal to do the merger. There are lots of companies doing mergers all the time, but the historical evidence doesn't support it actually. If the value it creates is only 1%, it doesn't look like a good investment. It's not a good project to buy another company. But still, companies continue to do mergers.